Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering 5 stocks with ex-dividends next week for the week of October 2nd through the 6th. So we're going to be covering whether the stock is overvalued, undervalued. We're going to take a look at its 1-year and 5-year growth. We're going to take a look at its payout ratio, whether it continue to pay out those dividends and increase it year after year. And we're going to take a look at its dividend history, see if it's recession proof. Has it paid out dividends through a recession? Is it recession proof? Or would they cut back on their dividend or just not increase it? So of course, if you are brand new to my channel, I do make stock market, financial, and investment videos weekly, so do consider subscribing to my channel for future financial videos. And of course, if you do subscribe, thank you very much. If you do like these type of videos, hit the like button and let's get into it. So the very first stock is Quest Diagnostics, and I have the ticker symbol here, DGX, and it's a Fortune 500 American company providing clinical laboratory services. So looking at its current 1-year, we can see that it has had very good growth as of November 2016. It had shot up to a high of around $110 before falling back down to currently sitting at $94.30. So it has had a loss of around 12%. So definitely would want to take a look at why it's gone down in the past. And since July, why it's gone down so much, that would definitely be an important note to take a look at. As far as its dividend here, let's take a look at its 10-year dividend. So up until hadn't had any dividend growth up until 2011, and increased their dividend growth and then increased it gigantically. You can see that they went from, say, 17 cents to around 35 cents, so nearly a 50% increase in dividend pay. So this could be a good one for the long-term buy and hold, but of course we'll get into that here in just a minute. This is a brand new screener that I sort of built and have used for my sort of investment. So I'm going to go ahead and just type in the ticker symbol DGX. It's going to be pulling up its 52-week low of 79.12. I'm not going to go ahead and do a lot of 52-week low 79.12, 52-week high 112. Current price is $94.30. Its earning per share is $5. So if we take the price and divide it by the earnings per share, we get a PE ratio of 18.8. So it is below my rule of 25. So it is, it's earning a good profit, and it's not too overpriced. In the bull market that we've been in, you see a lot of those companies out there that have very high PE ratios, whereas this one is sitting at about 18.8. Of course, I would want to compare this company to the industry average for its industry of, I believe it's medical, it's clinical and laboratory services, so it's right in that healthcare sector. It pays out $1.80 per share, or quarterly it's at about 45 cents. So 45 and 45 is 90, and 90 is 180 cents. So $1.80, I mean. So 45 cents per share. So if you spent $1,000 and picked up 10 shares, you would get paid $4.50 per quarter, or 450 is 9, and then 2 is 18. So $18 in a year for those 10 shares. It's not too bad. Its current yield, its 1-year yield is around 1.87. It's currently sitting on a 1.91% yield. So I did see slightly here that the red is above its current price. You can see that the red is sitting at 1.86 and the price is sitting at $94.30. So this one says that there is a difference of about 0.03%, meaning that the stock is slightly undervalued at this time. Now, let's go ahead and type in the ticker symbol, which is DGX. You saw my next stock. Quest Diagnostics, again, Fortune 500 company. Take a look at its 1-year. Look at this loss right here. From September 11th until September 26th, the loss of 12.87%. So that's nearly a 13% loss. So I would definitely want to research why this company has lost such a, from such a large amount in such a short time. Further 1 year, they were up 26% up until that loss there. They're down to around 11%. So maybe, you know, the investors are cashing out on their investments at the high, and that's just everyone selling off in their position. It kind of fell back down to it was at $98 prior to this huge spike here, and now it's at $94 again. So probably just if you were to cut out this huge portion here where it just shot up and just kind of drew a line across, it would be sitting around that same price, slightly higher. So I think this one will rebound in the upcoming days. It may be their earnings report that came out. I'm not going to look at that information right now. That's if you're interested in this company, of course, take a look at it. Let me know in the comments below what you find out if you do look into the specific company a little bit more in depth. Taking a look at its 5-year, has had 50% increase over 5 years, so averaged around 10% per year, along with that dividend yield of nearly 2%, so around 12% return per year. That's very nice, beating the S&P 500. Definitely a nice one to look at, to add to any portfolio. Let's go ahead and take a look at dividend.com. Why am I typing in .com? Of course, its payout ratio is 31.6, so very low, below the 60% rule that I have. It means that it's reinvesting nearly 70% of its earnings back into its company. It's had dividend growth for at least 5 years. Its payout, its ex-dividend date is on October 2nd, which is next Monday, meaning that you will need to purchase the stock on Friday to be eligible for the ex-dividend date on Monday. Once you have purchased the stock on Friday and you do have it during the ex-dividend date, you will be paid on October 18th. So it is a 1, 4, 7, and 10 paying an ex-dividend stock. So the next time this one would return would be in January. It has had annual growth of 7.5, so I like to look at stocks with growth of 5 to 8%. So this one would definitely meet my rule. Let's see here. Taking a look here at its information. Let's see here. It looks like there should have been a stock split. There it is. So there was a stock split. They didn't cut back on their dividend. They just kind of continued to pay out the same one from 2006 until 2011, and then they increase it to 17 cents, and they increase it by 50%. So very nice increase here, 17 to 30, nearly a 50% increase, and then just has had nice 7% increases since then. So this could be a good one to buy and hold for the long term. I don't see it going anywhere. Looks like they're pretty responsible. You know, they did a stock split. They kind of held off an increase in their dividend until they felt it was time, and then, you know, all those investors that had that stock during that time, 2 for 1 right there, and then they didn't cut back on their dividend. They kind of continued. So if this one is a stock split again, you know, they may not cut their dividend. It has had nice annual growth. They're only paying out 31%, so this could be a very nice one for the long term, adding to anyone's portfolio. So let's go ahead and continue on here. You can see here 1, 4, 7, and 10. So again, right along with what I had said. The next stock is, we already did that. The next stock is BNS, which is Bank of Nova Scotia, BNS. There we are. And let's go ahead and take out that dividend there. So of course, BNS, or Bank of Nova Scotia, is a Canadian multinational bank. It's the third largest bank in Canada. So we can see that its current price is $64.12, and its current yield is 3.54. So it is very overvalued at this current time. You can see that its average. Let's go ahead and just put it over here. So BNS. Its average 1-year yield is around 4.36%. That's a little bit high. 4.36% is actually higher than it looks like it's ever had a yield in the last 5 years. So actually, right here, look at that. Look at that yield of over 5%. So I have to take a look at how my information is getting pulled. I'll have to redo the math later. Anyways, let's see here. Just looking right here at this chart, you can see that the average dividend yield should be around 3.9%, but it's currently sitting at 3.5, so it is slightly off. This one says a yield of 3.95. So what may have happened here? I'm just going to go ahead and go over here to Google, and what I think happened is that they increased their dividend payout. So 3.94, 3.95. So what happened here is that they probably increased their dividend payout, and this chart does not show that information. And it's not going to tell me. It's going to tell me right down here. Right here, okay. So right here they increased it from 57 cents to 79 cents. That's a huge increase. They're just trying to play catch up because last year they cut it back by 8%. So if we did the math on it just really quickly, let's bust out the calculator and type in 0.79 minus 0.57 gets us 22 divided by 0.57 is 38% increase. So we'll just times that by 100. So that's an increase of 38.5% from 57 cents to 79 cents per quarter. So that's a very, very big increase. They're probably just trying to play catch up. So this one was actually correct, but even with that dividend increase, they're not currently undervalued. So my information shows that they are currently undervalued is set to no. Their 1 year average yield is around 4.36 with that new change. They're currently sitting at a yield of 3.95. That means that there's a dividend difference of negative 0.41 to even be about average. So I do like my information here. It's very useful, especially here the PE ratio. It's only 12.36, so they are trying to play catch up. They've had nice earnings, $5.19 per share. They're only trading at 64 cents and $64.13, which is, it's trailing on their high portion. So again, let's see here. Is that their stock here? Okay, so they're on a very nice run up. In the year they're up 20%. So I could see them they're on a long bull. From May until now, so I could see the stock dropping to kind of fall back just a little bit. Maybe investors cashing in on their earnings. So very nice 20% return in a year, or they've been trailing sideways for their 5-year. It looks about only increase of 3 or so percent. 17 by 5 is about 3%. 17 by 5 is 3.4% per year. Add in that dividend yield of nearly 4, you're going to get a average yield per year of about 7% per year, which is right around average with the S&P 500. But the S&P 500 is 7 to 10% with a yield of around 2.5. So if you invested in the index for the S&P 500, you'd actually do much better than just investing in Scotia for the 5-year. Let's see here. What is next? So we talked. It's not undervalued. It is overvalued. We talked about the difference in overvalued. We talked about its 1 year and 5-year. It has a payout ratio of over 60%. So it's had no dividend growth. They're playing catch up right now. Ex-Dividend date is on Monday. So of course you needed to buy it on Friday. You would be paid out on October 27th. So another 1, 4, 7, and 10 paying stock. Annual growth for 2016, we covered that's -8, but they increased their payout ratio their payout from 57 cents per share to 79 cents per share, meaning that they increased it by it was 35.5% increase. So they are trying to play catch up. They've had a couple stock splits here, 2 for 1, 1 for 5. So they actually took all the shares that were out there and combined them, so they gave out 1 share per 5. So kind of odd. Qualified dividends unknown. So interesting stock. Let's go ahead and continue. I am at 14 minutes only on the second stock, so I'm going to go through these next ones pretty quickly. So ERIE Indemnity it's kind of like it's an insurance services, so they provide sales, underwriting, policies. This one's currently trading at $119.36, yield of 2.58. We can see that it is not overvalued, or it is overvalued. Let's go ahead and just punch in that ticker symbol here just so I can show you the correct information here. So its 52-week low is $98.36. 52-week high is $129. It's sitting at $119, so $10 off its high and nearly $20 off its low. So more room for the fall. Its earnings per share is $4 and its price to earnings. So its current price, $119 by its earnings per share 4, gives us a PE of 29. So it's very high. Especially as an insurance company, you know, they issue a policy insurance services, so it seems pretty high for that. I would definitely look into its industry to see what its PE is for its industry. Its dividend is $3.13 per share. Its 1-year average is 2.74. It currently has a yield of 2.63, so it is not undervalued at this time by about 0.12%. So not an undervalued stock. Let's take a look at its 1-year and 5-year. So ERIE. So 1 year, boy, this stock, look at this pattern. It could be a nice swing stock. Look at that, 1% loss in an hour, followed by a 1% gain, and then a loss of 33. So this could be a good day trading stock if you do that, but I do not. So let's go ahead and look at the 1 year. 1 year growth of 16.8, so 17 by 1, 70% increase per year. Very nice growth for the 1 year. Take a look at its 5-year, 85.31% increase for the 5-year. So 85 by 5, 85 by 5 has averaged 17% per year with the dividend yield of 2.63% right now. That's very nice. It looks like it did dip here in the last. This one's so sporadic. Look at this. It's gone down 7.46 as of Friday, July 28th. So it's kind of on a downwards trend. It's probably just kind of it may fall back down into its support. It's been falling since July. That was kind of its peak, and then it's kind of trailing down. So it does have a high price to earnings ratio. So this could be one that's just kind of recovering, falling back into its place. Ticker symbol ERIE. It has had dividend growth for 21 years. It does have very high payout ratio of 80%, meaning that they only reinvest 20% back into their company. We talked about they're a sales underwriting policy insurance services, so they do property and casualty insurance. We've already covered their dividend growth. Their ex-dividend date is on October 4th, so you would need to buy and hold the stock next Tuesday to be eligible for its ex-dividend date on Wednesday. You would then get paid on October 20th, so it's another 1, 4, 7, and 10 paying stock. It's had dividend growth of 7.2%, so it does meet my rule there of having good growth. Had a very nice special payout of $2 per share back in 2012. So this is actually a very nice buy and hold stock. I'm actually a little bit. I have to look into why they pay out such a large amount from their price to earnings. That would be something to research. Their earnings. I would have to take a look at how their earnings has been for the past couple quarters and see how they're doing. But right now, their dividend growth has been 21 years, meaning that they've gone through several different recessions, pullbacks. The 92, the 2000, the 2008. So they have gone through. They've gone through all of those, and have continued to increase their dividends. So this could be a good buy and hold one. So very good dividend history. Payout ratio is a bit high, but it does have nice dividend growth and dividend history and dividend and just 1 year and 5 year growth. So good one there. While it is slightly, it is not undervalued. It could be considered a good company to add to any portfolio once it is at a nice undervalued point. So the next stock we're going to be covering is Village Supermarket Incorporated, which is ticker symbol VLGEA. This is one that I've really never heard of. Has a current yield of 4.06%. It's trading at $24.64. This one, it's a chain of supermarkets in the United States. It's ShopRite. They have around 25 supermarkets, mainly in the New Jersey area. I think they have like 18 of them in that area. So very, very central to a specific group or area, which could be its sort of downfall. You know, it's not global or it's not national. So if something, you know, that specific part of the United States gets hit by some sort of either weather or, you know, natural disaster, that could take their business down quite a bit. And we can see here that they have been trailing down as of January 2017, where a lot of stocks have been trailing up during this bull market. This one has been trailing down. Would want to research this one more. You know, it could be a value trap. You know, this one has been trailing down for over 9 months now, but it does look like here it bottomed out around $20, and it's kind of trailing back up now. You can see that September it bottomed out and it's trailing back up. If I put in that ticker symbol into my information here, it's VLGEA. We can see that its 52-week low is $22.43. Its 52-week high is $36.42. Its current price is $24.64. So it is very close to its 52-week low, meaning that it hit its support line at its 52-week low and kind of bounced back. Its earnings per share, it is positive. It's at $1.69 per share. Its price to earnings is 14.6 times over. Its current dividend is $1 per share. So for each share of that company, you will get $1 per year or 25 cents per quarter. So this actually has a very nice yield. So you'll see here that its current yield is 4.06. Its 1-year average yield is sitting around 3.4. It does have a dividend difference of 0.66%. It is showing that it is undervalued, but again, undervalued doesn't mean it's always a good buying opportunity. You would definitely want to research this one. Why has it been on a downwards trend? What sort of what is going on with the company? What is causing it to have had such a loss here in the last year of nearly 23%? You can see here, remember, it bottomed out here at 29%, and then since then has been increasing by 7.6% since September. So what caused it to bottom out? That would be something interesting to take a look at. This could be a great buying opportunity for the long term. It has a very low price to earnings ratio, has a very decent dividend yield, and it looks like it finally hit its support line and it's increasing, kind of balancing itself out. So let's go over here and take a look at its payout ratio. So its payout ratio is it must not be making any. It was making some earnings. It was making $1.69. So I'm just going to go Yahoo Finance real quick. Oh, I spelled that wrong. I would like to just take a quick look. I don't normally do this during these videos. Let's see here. Okay, it doesn't have any information for me there. See here, let's go to a statistics. You know, I'm going to be increasing this. The length of this video is going to be, you know, I only have one more stock to go. So 3.46, 3.4. So my information is just slightly off, just because of the way I calculate my differences. Dividend date, ex-dividend date. Okay. Let's just go ahead and go on. I'm not going to research that. It wouldn't show me my earnings per share, what it's been for the last quarters. So the very last stock is Barnes & Nobles. Of course, this is the one that I was talking about. This is the only one that I've really, I know myself. You know, it's a bookstore. I go and buy stores. We have one about 2-3 miles away. I can either ride my bike to or just kind of walk to if I would like to pick up books. But of course, Amazon's out there, and that's what's causing the stock to kind of tumble. You know, retail has been hit hard by, in the recent months and years, by Amazon kind of taking over that sector. So Barnes & Noble is currently sitting at $7.67. So that is very low. Its yield is 7.82%. So right now it is undervalued, but is it a value trap? I believe this one would be a value trap. You can see its 52-week low is $6.25. 52-week high is $13.20. Its price right now is $7.70. Its earnings per share, it's very, very low. You can see that its earnings per share is only 35 cents. So I'm sure this one, oh dang. Let's go ahead. I just want to look this one up again here. I'm interested on what its earnings has been in the past quarters. It just looks like this one is just kind of falling. I don't know why its first quarter was so much, but this one just doesn't look like it's going to be upkeeping. You can see that it's been falling and falling and falling. So their earnings per share and their earnings estimates are kind of going lower and lower into the negative. So not a good outlook on Barnes & Nobles. They do have a very nice yield of 7.79, but I believe once we start looking at their information here on dividend.com, we'll see that they probably can't keep up with that any longer. So 1 year they've gone down nearly 29%. So that's a huge loss in a year. In 5 years they've gone down nearly 40%. So 40 by 5 is 8. So they're losing about 8% average per year. Even now their price to earnings is 21, so their earning is very little and their stock is so low right now. But wow, it's very hard. This one, it's a great bookstore. I see a lot of the public going there to read books, but so many of them just sit and read and use their facilities, and a lot of them I don't think actually purchase the books. They just kind of sit there and read them. We can see that Barnes & Nobles has a very high payout ratio, dangerously high, 117%, meaning that they can no longer keep up with paying out to their shareholders. There's going to be a point where they're going to have to cut back on their dividend, which is going to cause their shareholders to sell off on their stock. And that's what's going to be happening. They can't have any more growth right now. That's unfortunate. They have had annual growth of 100%. I'm not sure what the heck that means. Let's go look over here. Oh, they were not paying any dividends between this time frame just because they could no longer afford it. And it looks like they paid out dividends from nothing until 15 cents, which is a 100% increase from what they were paying. So that's what that 100% means there. Unfortunately, I don't believe Barnes & Nobles is going to make any sort of comeback. They're a specialty retailer in books, and you can get all your audiobooks, all your physical books, and digital copied books on Amazon these days, and get it delivered to you within 1 to 2 business days. So Barnes & Nobles, it's a Fortune 500 company, but the bookseller, it could be one of the largest. It is the largest number. It has the largest number of retail outlets in the United States for books, but it's going to have to close those doors. It's going to have to pull back on paying out dividends to its shareholders, and you're going to see this stock probably continue to tumble and fall even further once they do end up cutting back their dividend of 60 cents per share. So that is it for this video. I have covered Quest Diagnostics, Bank of Nova Scotia, ERIE, Indemnity Company, Village Supermarket Inc., Barnes & Nobles. Of these 5 stocks, I believe that the only one that actually there were 2 of them that were actually very nice. Of them, Barnes & Nobles is the current winner of the undervalued ones, but of course that's a value trap in my opinion. Village Supermarket, it's another value trap. I don't see this one that's very focused in New Jersey really springing back up and becoming profitable, continuing their growth as they've done. Quest Diagnostics doesn't look too bad. They are slightly undervalued at this time. It could be a good buying opportunity. Remember, that was the one I believe lost 12% in the last month. So would definitely want to research that one as to why. And then we have our ERIE and our Bank of Nova Scotia. So that is it for this video. Let me know in the comments below if any of these 5 would be ones that you would be interested in purchasing. Do you own any of these 5? You know, Barnes & Nobles is a pretty popular one that I've seen other investors talk about. Just never heard anyone actually owning that one. So go ahead and leave your comments below. Let me know if you like this type of video. Let me know if you have ever heard of any of the 5 that I listed in this video. And that is it for this video. Of course, I do want to thank you all for watching up until this point. And if you have enjoyed the video, do hit the like button below. It does help out my channel. If you are brand new to my channel, do remember to subscribe by hitting the subscribe button below. And if you have any questions, leave that in the comments below. I will always reply. Thanks for tuning in, and I will see you next time. Bye.